Hello and welcome to this video on competition policy and regulation. So in this video we're going to look at how competition authorities protect consumers and regulate industries. So we've established previously that if firms grow, they may become monopolies or exhibit similar characteristics. This often leads to higher prices and reduced output, as well as a range of other disadvantages to do with efficiency, consumer surplus, and barriers to entry. So often governments will want to try and deal with the issues posed by monopolies, and so they will set up what are known as regulatory bodies or regulators. So regulators are appointed by the government to oversee how a market works and the outcomes that result for producers and consumers. In the UK, the main competition regulator is called the Competition and Markets Authority, or CMA. In Europe, the European Union Competition Commission is also an important regulator for firms operating in the EU. The Competition and Markets Authority is a department within the government responsible for carrying out investigations into mergers and takeovers, investigating markets and how they work, regulating certain industries, and enforcing competition law and consumer law. So some examples of regulators in the UK. We can obviously see the CMA, they're the overall regulator responsible for any market in particular. But certain industries also need regulators, and you'll see they often say off something. So for example, this off stands for office. So the office, the government office of water regulation, we call Ofwat, and they are to regulate water companies. The government body that regulates telecoms and broadcasting companies is called the Office of Communication, Ofcom. For electricity and gas providers, it's called Ofgem. For rail networks, it's called the ORR, the Office of Rail Regulation. For banks, it's called the FCA, Financial Conduct Authority. So these are governmental organizations or departments that are responsible for overseeing competition in those particular industries, or for the CMA, overseeing competition in markets as a whole. So what do these regulators do? Well, number one is they monitor and regulate prices. One of the problems with a monopoly power is that you can charge excessive prices. Now, regulators have the legal power to influence the price that a monopoly company can charge. So they monitor prices, and they can also intervene in the market, set maximum, minimum and pricing formulas to ensure that a certain price is being charged, a fair price if you like. They also monitor standards of customer service, so they can specify certain standards. For example, for the railways, a certain amount of trains have to be on time, 97% for example. Companies that fail to meet the standards of customer service can be fined or have their privilege to be this monopoly, this license, franchise taken away. The regulator can also try and open up markets, so they can try and encourage competition by thinking about how things might be done differently. So for example, in the railway industry, the regulator can try and encourage competition by forcing the owner of the track, the rail track, to allow other companies to run services on that particular line. Overall, regulators are trying to act like a surrogate competitor. So obviously for the monopolies, we don't really have much competition. So the idea of the regulator is to try and act in a way that mimics or imitates what could be achieved in a competitive market. So they're acting like a competitor, trying to get the same sort of outcome as if there was another competitor in the market. Now, often regulators are very important where we have the case of natural monopoly. So where we have significant economies of scale, and it only makes sense for one business to really provide the service, then we need to ensure that this one business is regulated and faces some sort of competition. An example might be the water industry. So if we think about something like Thames Water in the UK, which is the monopoly tap and sewerage provider in the kind of southeastern London area, they are regulated by the body we mentioned earlier called Ofwat. So these are private companies that operate, but they're granted a license by the regulator. The regulator monitors the water quality and produces environmental standards, and also sets targets for things like customer service and the amount of leaks and so on. In the water industry, the regulator caps the rate at which prices can rise. And quite an interesting way in which they do it in the water industry is they say that prices can only rise by inflation minus X, where X is a certain amount that's trying to mimic some sort of competitive pressure. So you can put your prices up by inflation, but we subtract a certain amount because we think you should be getting more efficient. And then they add on a final amount they call K, which is an additional amount firms can charge to generate money for investment back into the water and sewerage network. So if inflation was 4%, they can raise their prices by 4%, maybe subtract 1% because that's how much they should be getting more efficient if there was competition, so 3%, and then maybe they're allowed to charge an extra 2% to generate money that they can invest back into the network. So overall they'd be able to raise their prices by a maximum of 5%. They also have a responsibility to ensure that companies can finance investments to improve service, and they should be monitoring customer service, sustainability, and standards within the industry. Another way of trying to introduce competition is to try to split out the core service from the service to the customer. So for example, in railways, they try and split out. The regulator will say, well, one organization will provide the track and will regulate that particular business, but then there can be competition between other companies for the right to run trains across the track. And so this would be a slightly different way of regulating to introduce competition into the market. So we've looked at regulation. Regulators are also responsible for implementing competition policy. So the main aims of competition policy, which include competition law and consumer law, are to promote competition, make markets work better, and contribute towards improved efficiency in individual markets and enhance the competitiveness of businesses. Competition policy aims to ensure that there is technical innovation which promotes dynamic efficiency. So dynamic efficiency comes about is increased efficiency through technology changing over time. We want price competition between suppliers, sellers, and to protect the interests of consumers through increased choice and lower price levels. So this is what competition policy aims to ensure. So the main areas in which competition policy is involved in, they try to eliminate cartels, or trying to, what they call it in America, antitrust agreements, when firms operate and collude together. Try and make markets more liberalized, so trying to introduce competition in maybe previously more monopoly or oligopolistic, or areas where there was previously less competition. They will try to ensure that there is control over the amount of state aid that certain firms receive, and hope that this is not disrupting the market. So for example, several airline manufacturers receive significant subsidies from governments, and competition policy aims to try and ensure that these subsidies do not distort competition within a market. And lastly, merger control, to control, investigate and control mergers and takeovers, which we have mentioned previously. So regulators will be concerned with any sort of anti-competitive behaviour occurring within a market. So for example, price fixing or sharing out market share, predatory pricing and limit pricing, excessively high prices for consumers, refusing to supply or discriminating between who you sell to, misusing patents, so maybe registering a patent but then actually not using the technology just to protect your business, and also maybe protectionist policies that limit overseas trade. So what powers do regulators have to try and change business behavior? Well, they can fine, they can introduce quite significant fines to companies that they find have breached competition policy. They can remove the license. So for example, if they found the water company was not doing a very good job, they can remove the license that company has to be the sole water provider and give it to a different company. They can force certain businesses to shut down if they're breaching competition policy. Some of employees who are found to have engaged in illegal practices can be sent to prison. Those employees can also lose their right to be directors of businesses for a certain number of years. As we've seen previously with supermarkets, for example, when they merge together, they can be forced to sell off particular assets in order to preserve competition. There can be certain legal proceedings that can take place. We can take a company through the courts, try and get them to change the way in which they behave, for example, environmental damage. And they have the power to conduct investigation and demand that businesses provide them with information in order to reach conclusions about competition issues. So some examples on the right hand side, there are two news clips here of two companies that were involved in anti-competitive behaviour, and the punishments. A fine of £270 million is the first one. That was for British Airways, and that was for price fixing on long-haul flights with other companies. The Royal Bank of Scotland, the bank, were fined £28.6 million for sharing information on loan prices. Orange, a large European telecoms provider, were fined €350 million for abusing their market dominance, abusing their dominant position in France. The Competition Commission found Google guilty of abusing its dominance in web searches to steer European consumers towards its own in-house shopping services rather than services of competitors through the search engine. A number of banks were fined £485 million for manipulating interest rates. And finally, that story on the right hand side there, some former Barclays employees were jailed for between 2 to 6 years for colluding over interest rate charges with other banks. Regulators often want to reduce anti-competitive behaviour, and often the people who know best what's going on are the actual companies themselves that are committing the anti-competitive behaviour. So competition authorities offer what's known as a whistleblowing policy and are often lenient when that happens. So often authorities will be lenient on businesses if they make amends for their actions, or if they notify the authorities that anti-competitive practice has taken place. So for example, the Competition Act in the UK allows for businesses who are a member of cartels, who are maybe involved in price fixing, to whistleblow on each other and inform the authorities that the other members are doing this particular practice. If they do this, if they whistleblow and tell the authorities that the other members of the cartel are doing this, then the authorities tend to be more lenient in terms of their treatment. So they may have any penalty substantially reduced, or they may be able to avoid a penalty altogether. So let's move on to some evaluation. When does regulation not work very well? Well, this cartoon on the right hand side alludes to the concept of regulatory capture. And this is a form of government failure when those bodies regulating the industries become sympathetic to the businesses they're supposed to be regulating. Regulatory capture can mean monopolies can continue to charge high prices because the regulator is not effective. Sometimes you see people moving between companies and the regulator, and this would give the question of, are they really being independent, or actually are they maybe being too sympathetic to the industry at the risk of allowing consumers to be exploited? Some other issues in evaluation: there may be some asymmetric information. Often the regulator doesn't fully know all the information about what's going on in the industry that they would need to in order to enforce competition policy. Sometimes the public sector can be inefficient in terms of its ability to investigate these businesses. There is the possibility of corruption that hasn't been unheard of for businesses to bribe the regulator. Often the regulator is under-resourced. There's maybe a kind of small department overseeing a very large industry which has significant financial and manpower. Often firms want regulation. In fact, they think it's easier to have a regulator than maybe to have a competitor. So in this video, we've looked at how competition authorities protect consumers' interests and regulate industries. That's it. Thank you very much for listening.